It's Equity News on Equity Access, your cross-section of the stock markets and of developments in the Zimbabwean economy. A beautiful evening it is to you. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's get on to business. Our news tonight, listed plastics manufacturer Proplastics today held an analyst briefing in the capital with the presentation of the financials being made. While Proplastics historically is formerly Murray and Roberts and Masimba Industries Limited, and it is the only listed plastics and pipes fittings manufacturer that we have in Zimbabwe. Proplastics manufactures pipes as well as fittings for applications in a wide range of activities from irrigation, water and sewer reticulation, mining, telecommunications, as well as building, or should I say construction. The company recorded revenue of 24 million as well as profit after tax of $3.5 million. Finance Director Pascal Changunda gave an update. Let's have a listen.
Turnover rose by 50% to 24 million. Volumes 5% to 5,261 tons. And try not to rush overheads due to the inflationary pressures, up 45% to 3.9. And of course, the EBITDA up 5.7 from 2.9. PBT to 4.8 million from 1.9 last year. That's what the graphs were trying to show, and those are the numbers. Profit for the period, that's after tax, 3.5 from 1.3 in the prior period. We took a knock on our current ratio, and still a final 1.8:1, but we're 3.1:1. We gobbled quite a bit of cash. We were sitting on quite healthy cash resources at the end of 2017, but we've utilized that mainly into the new factory. Quick ratio naturally also went down. Debt equity is on 10%, we're 4%, so we've grown our borrowings a bit. We expect it to rise even further to about 12-13% in the first half of the year, and it will ease back towards the 10% and beyond. Turnover.
Now, to take a dive into the financials as to how they've performed over the past few years, well, coming from a base of 2014 where they did record revenue of $13.3 million as well as profit after tax of $0.1 million. 2016 revenue there of 14.1. Well, it seems as though there was actually a decline from 2015 to 14.1 as well as 0.7 in terms of the profit after tax. 2017 profit after tax of $1.4 million as well as revenue of 16.1, and then there's that jump in 2018 to record a strong performance. Their revenue there being $24 million as well as profit after tax of $3.5 million against, of course, gross profit of $8.9 million. So this is actually how the figures have actually played out. Then as well, at the analyst briefing, the CEO Kudachi Gia highlighted the need for foreign currency as the company needs $500,000 to stay operational. This is actually their import requirement, as 99% of their input is actually imported material. He also gave an update on a new factory which is 97%, which is expected to ramp up the production figures for the corporation. While Chief Executive Kudachi Gia gives us the update, so let's have a listen.
Writing on Mozambique, GRC, and Malawi. We're beginning to try to put our footprint in those three countries. Most of the turnover that we derived on our exports were actually, for this past year, were actually coming from Zambia. Outlook. The major challenge that we continue to face as a business is actually the availability of foreign currency. The monetary policy came with a trading platform where we could trade our RTGS balances that we have, but that's taking too long. I think it was implemented as a piecemeal, and we hope that as soon as it's possible there will be an equalization mechanism that will attract the black market RTGS and the official RTGS, so that we've got a common nominal value that can freely trade without any impediments. Actually, that's affecting most of our businesses in Spain at the moment, because we can't get the sellers that are willing to dispose of their in foreign currency at the rates that are actually being preached at the moment. Where we see growth, we will still ride on our civils, we will still ride on our merchants, mining, exports. I think we've put in quite some investment as we speak. We've got men on the ground in Mozambique, irrespective of the disaster that we have from Cyclone Idai, both SME and irrigation segments as well. The new factory, I think we've been sharing the construction of the new factory for a fairly long time. All things being equal, we were supposed to complete this factory in November, December last year, and we were supposed to have equipped it by the first quarter. But we're finding it a challenge, both on the capex requirements for the business and on the opex requirements, that we have to find the two fronts, and there's really nothing much available in the market. So we had to sacrifice some of the equipment that was required in the construction of the new factory so that we could keep our operations going. And that is actually led to postponement of the completion of the construction of that new factory. As we speak, we're sitting at about 97 to 98% complete. As we have seen, it's still a construction zone. We hope to have completed the construction in April, beginning of mid to end of April. We'll start installation of the equipment. We already have got the equipment that have arrived from Germany. We already have got the equipment that have arrived from Italy. We still have got the large chunk that is still to come out of Italy. So we expect to commission the factory at the beginning of the first half of this year. Pascal will show you the numbers that we've put in there in terms of capital investment for the factory. This factory, if you compare it, I mean, it's a modern world-class factory that can compete with the Botswana, that can compete with the South Africa. And if all things were equal in this country, we wanted to compete with anybody else in the world. That is
the Reserve Bank of Zimbabwe has commissioned 26 bureau de change. Well, this of course follows the monetary policy statement that was rolled out on the 22nd of February by the Reserve Bank of Governor Dr. John Mangunjka, in which the interbank market was set alongside the introduction of a new currency, the RTGS dollar. Of note is a set of stipulations that was of course set where the invitation was made to various businesses to actually get into the bureau business. Now, of course, this move is an initiative to actually get rid of the black market and get forex trading within formal channels, as well as to enhance accountability in that sense. Several stipulations being a minimum requirement of $15,000 in capital, a robust system, maximum sales of $10,000 per bureau, a float of $20,000 and also those operating in the trade are expected to operate within a 2.5% margin plus or minus to the interbank system. Government expects formal trading of foreign currency to eventually eliminate the parallel market. Moving on to other news, Gambia signs off in favor of the African Continental Free Trade Area. Well, Gambia's parliament was the 22nd nation to ratify the agreement, the minimum threshold expected to approve the deal among 55 member states of the African Union. Well, African leaders hope the agreement will eliminate current high tariffs, generate employment opportunities for rapidly growing young workforce, and harmonize the work of already existing regional economic communities and help alleviate poverty on the continent. It could also enhance intra-African trade by 52.3%. That's according to the United Nations Economic Commission on Africa, the UNECA. Well, once in place, the AFCA will cover a market of 1.2 billion people on the continent, a combined gross domestic produce of 2.5 trillion, making it the world's largest free trade area since the formation of the World Trade Organization 7 decades ago. Well, we'll have a conversation on these and other issues just shortly after the break. Please stay tuned. Welcome back, viewers. I'm now joined in studio by our very own investment analyst, Anesu Chimvumo. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Can't want to complain. You should only get better yourself.
I'm all right.
Fantastic. Let's get the ball rolling. Listed plastics manufacturer today held, of course, an analyst briefing, and they recorded a very strong performance, growth in revenue to $24 million, as well as profit after tax of $3.5 million. Well, key, of course, to the presentation was the fact that there has been a 67% growth in terms of their export revenues in that regard. And they've said that this, of course, has been Zambia, and there are prospects for other countries like Malawi, Zambia, Malawi, Mozambique, as well as DRC. How important is this to the operations of Proplastics?
Well, I think it's very important because regarding that, these guys use 99% of their inputs in terms of foreign acquired inputs. It puts them in a very tight space where if they're only trading here in Zimbabwe, they would find it very hard for them to acquire foreign currency and then actually produce what they do produce. I mean, if the markets that they're actually going to be going into are some economic areas that are growing, where you'll find that more buildings may come into play. The construction side of things in those areas will be growing, which should spell extra pipes for them in terms of electricity and well as well as waterworks. So the growth in their revenues in that regard is very important. Though that the revenue in terms of their exports just constitutes about 5% of their revenue, it is somewhat helping them to an extent for the current moment, but it wouldn't pull them out of a quagmire if they get into one in the near future or going forward. I mean, they're really looking at expanding their operations. That means they're going to require more foreign currency. If currently they have a factory that's at about 97% completion.
Hold on a second before we get on to the factory. Key as well to the operations, right? As you rightly pointed out, that 95% of course would be to the local market. An interesting stats actually given by Kudachigia, who's the chief executive, who indicated how that in Zimbabwe we have a water system that is not operating at its optimum. And he said, look, the water systems that we have were erected some 40-50 years back, and his estimation is at this point Zimbabwe loses between 50 to 65% of its water, and there's definitely need for a repiping. So according to what he said, he expects more business to actually come from local municipalities, and he expects growth, from that particular direction. In fact, according to the stats, there was a 259% growth in terms of revenue from the local municipalities. So you look at those stats, you'd actually realize the possibilities that actually lie for the corporation going forward. Then now let's talk about the facility that is actually 97% complete. It should have been complete over the past year, but due to what was playing out in the economy, they couldn't actually succeed at having that done, and them being able to move forward. What potential do you think lies with the particular facility that is actually at the very verge of completion?
All right. Just to have a look at how the completion of that factory is going to be an effect on them, is they've been trading at between 4,000 tons and about 5,261 tons now as of late, which is the financial year that was closed. Now, once they complete, they are expecting those volume numbers to go up as high as 30,000 thereabout.
Wow, that's phenomenal.
So if the completion of that factory happens, then that means for them they can now cover much more ground in terms of the demand that is required. Because I mean, if you're looking at Zimbabwe alone, like you've mentioned already, there is a very huge potential market in terms of the water piping system of Zimbabwe currently, which is decades old. I mean, some of that piping is one of the reasons why our water systems are not delivering healthy water.
Precisely.
So you'll find that there is a need for them to revamp that system, and that's a huge market for them to talk about. But then, regardless of Zimbabwe, we also look at the other potential markets that they are trying to target, which is your Malawis, your Mozambiques, your Angolas, you name it. So with those potential markets being earmarked, they do need such huge numbers of volumes for them to also actually increase the contribution in terms of the export market towards their revenue, because 5% of their current revenue is okay. It has taken them this far, but then as the economic situation keeps tightening up, it makes it much more difficult for them to keep themselves at optimum levels of production. I did hear that as of late, since the interbank market opened, they only managed to source about $100,000.
Of which their import bill is 500,000 per month, and so they've actually depended on their previous stocks, and who knows what.
So you see the play around there. They already have a deficit of 400,000 in terms of how the interbank market has come up, and that deficit there needs to be serviced by something, and that should be in accordance to their export market. If they don't have a huger contribution in terms of revenue from their export market, then it will choke them later on in the following couple of years. So them having this factory opened, it should shoot up their volumes up. They have been gradually growing these revenues. I mean, 3,900 in 14, 4,800 in 16, and then now 5,261. This is a 5% jump, by the way, from the prior year. Okay. So it's a gradual level of increase, also just working with the current factory that they're working with.
Yeah, and them intending to actually take it to 32,000, that would actually spell positives, because they were saying, look, Zambia, there is a deficit for these kind of products in Zambia. Mm-hmm. So of course Zambia, Malawi, DRC, and also as you move north, so mm-hmm. they are hoping to actually service that.
Yeah, I mean DRC really needs it, because those guys don't have a water system currently. If you can only get clean water if you're in a hotel or in the low end type of suburbs, so that's a huge market for them to cover.
Okay, now let's move on to our next story. A huge victory for the continent. Gambia becomes the 22nd country to sign in favor of the African Continental Free Trade Area. Mm-hmm. I mean, this, just to bring clarity, 22 was the number that was required to at least get the ball rolling. So with Gambia's parliament actually voting in on that, this has actually changed the complexion, or in terms of outlook for the continent. Would you want to shed more light in terms of how significant this is for the continent?
Well, it's a very significant move, but then also it may be a little bit damp for other countries. We'll get into that a little bit later, but we were looking at a 22 threshold. Now the threshold can get the AU summit to a place where they can start working on the bill and other issues around that whole free trade area. Now, if we just have a look at some of the trade agreements that have been within the continent, we have your YMU, your EAC, your COMESA, your ECOWAS, your SADC, your CEMAC, and your SACU. Now, one area that is of very, very important notice for me is your EAC, where you find your Uganda, your Kenya, and your Rwanda as well. These guys have managed to work with a very solid economic union, where you find all of these countries actually have been growing at a very, very good rate, because of the union that they have. Now, the union does comprise of them having some trade agreements that do allow for them to have a little bit more free flow of products. But then the big issue with these four countries here that I want to touch on is that they started off almost at the same level of production in terms of advancement in their economic levels.
Okay.
Now, when they started off, they were almost at the same level, and they have grown together at about the same rate, an excess of about 5-7% in terms of their GDP growth, dating back as far back as 09 or 10, 11, thereabout. So there needs to be a notice of how some countries in the AFCFTA are going to be pushed down, or rather are going to stay in a place where they are not going to be able to develop. Why am I saying this? We find that in Europe, there's a case of the pigs, your Portugal, your Italy, your Greece, your Spain. These 4 countries are not the strongest in the European Union. They do enjoy the European Union agreements thereabout, but then because of their weakness, you'd find that Germany and France are the countries that actually determine how that free trade area goes, and it would be mostly to the benefit of them. And this suppresses countries like the pigs, the ones that I've mentioned, Portugal, Italy, and Greece and Spain. Now, in Africa, we have countries like us, Zimbabwe. We have countries like Malawi. Well, Malawi has been fairly doing well. You've got Zambia that's going into a place where it may be a very tight space for them going forward. I mean, they have a lot of debt that they have to deal with. You look at, I'll suppose probably even Gambia. They're not very strong in terms of the economy there, but if they have a situation where South Africa is in that AFCFTA agreement, South Africa is going to pretty much make most of these countries supermarkets. Because their level of production is pretty high.
Okay, let's come in and let me come in a little bit then, just perhaps try and shed more light so that we bring perspective. We're saying on the continent, 3 countries contribute 50%.
Yes.
Of
excess of 50%.
Yes, of Africa's GDP. That's Nigeria, Egypt, as well as South Africa.
Good thing Nigeria isn't in the agreement as yet.
Fantastic. How, right. So, how important would that be to the continent, considering we have such disparity on the continent? If it were in a country, we talk about the Gini coefficient, but now I'm not sure what unit we use to actually measure the disparity in terms of GDP performance at a continental level that would actually spell out that particular story that we have playing out on the continent.
Well, it's going to be a very tough thing for us to really go about it, because the bigger economies are going to have a very good field day in terms of this trade agreement. They're going to enjoy a lot of growth, but then they do also have their faults and problems that they're facing currently. South Africa has been facing some threats, especially to do with mineral commodity prices not being very strong as of late, which has not benefited them very well. I mean, they are part of the SACU. They pretty much dragged down how the SACU performed in 2018 mostly, and also 2017 mostly because of that commodity price issue. So such a country, if they have the opportunity to grow, Zimbabwe becomes a supermarket, like I mentioned earlier on. So there is opportunity for every other country to grow. Yes, that is if we adhere to very stringent policies and.
Your argument is about us being able to actually lay out the framework that makes this thing work.
Yes, because if we don't have a framework that supports every other nation, then the stronger keep getting stronger, and the weaker remain weak, or they grow at a very stunted rate. But then it's not all bad news. We will have the opportunity to actually attract a lot more investment. I mean, a bigger market does spell out a lot more opportunity for investors outside of Africa. We do talk about better employment rates coming off. Into unemployment rates actually coming off. We also have the opportunity for production numbers to go up, and also if we have a little bit more agreement in terms of what kind of currency is going to be used, how are we going to be working towards a stronger and a better currency. EAC, which has pretty much caught my eye. I mean, the respective countries, they don't actually present their budgets to the parliament before they present it to the EAC committee.
I realize.
So you'd realize that these guys are working towards having a union that has got unity in terms of how they're going to move forward as an economic union, and what areas do they need to tighten and which areas do they need to loosen for them to still stimulate a lot of growth. Rwanda has been doing very well. I mean, they've been advertising themselves as a very good tourist destination as of late. I mean, you talk about Uganda.
Okay, I know you can go on and on where that is concerned. We're just going to take a break. When we come back, we'll have a look at the performance of the stock market. It will be interesting to see how the story actually develops in this regard. Please stay tuned. Welcome back, viewers. I'm still with Anesu, an investment analyst for Equity Access. Anesu, please take us through the stock market and as well as how things have actually closed at the interbank system.
All right. The stock market was a damn day again, second day running. All four indices actually came off. Mining's index giving in on the steady run of about 6 sessions on the same level of 193.98. Now it's down to 192.06 points, which is a 0.99% decline in that regard. The top 10 index did shed off about 0.05% for it to settle at 114.20, pretty much because of the biggest loser today being Econet in that index, dropping about 0.56%, while Cassava also lit up about 0.25%. The industrials index did shed off very minimal percentage. They're coming off 0.01% for it to settle 405.20 points, while the All-Share index settled at 121.52 points after having come off 0.03%. InScore among two other top 10 counters were in the positive, pretty much splitting the bill there in terms of the rises and fallers in the top 10 index. Econet, Cassava and Sidco were the fallers in that regard, and InScore, Old Mutual and Padenga were in the positive. Padenga, like I've always mentioned, they have a foreign currency earning power potential. Rather, it's not a potential. That's the core of what they do.
Represent, yeah.
Yes, Old Mutual, being a fungible stock, did inch up by 0.01%, adding to 800 cents. Now, All-Share index is now down 0.12% on the 5-day trend, while the mining's index is also down 0.99%, pretty much because of what happened today. So that change is almost similar to the day-on-day change. the top 10 index still is showing its strength in terms of how the market is being determined as of late, with it being down 0.36%, which is pretty much almost three times a larger decline versus the all share index, and the industrials index is down 0.09%. Now, for our risers and fallers, Meikles did come up 5.38%, while First Mutual's property division subsidiary actually added about 1.35% to settle at 6 cents. Padenga, we've spoken about those guys, and as well as Inscore and Old Mutual. Bindura Nickel, which was the reason for the minings index to come off today, did let up about 3.79% to 6.1 cents, while Ariston also gave up 1.02% for it to settle at 2.9 cents. We've already touched on these three again. Now, onto the interbank market, forex market.
Central bank, they're commissioning additional bureaus there to play in that space. Perhaps this would, of course, spell out the intentions right from the onset that they intend to, scale things up in the formal arena and try and beat the parallel market in that regard.
Well, the interbank rate, as of late, has been weakening. I've often said that there hasn't been any clarity as to how that market is performing, really, because we don't know how much the government has injected into the economy for this interbank rate to actually perform. Earlier on, before other factors that could actually strengthen or weaken this rate had come into play, we were speculatively talking around that area, because a lot of people thought that when they would go to the banks, they would be able to get hard currency in terms of the US dollar if they trade on that interbank rate. But then it has just only been a movement of figures from their RTGS accounts into their Nostro accounts, and if you want to get a hard cash, it will be privy to the bank and its ability to actually give out that. But then most banks, I don't think they have that kind of power to actually give out the US dollar. Now, adding to that speculative behavior that we had been putting pressure on the rate, is the fact that the central bank has shown inability to actually pay off farmers in the tobacco farmers. Tobacco farmers were expecting to be paid in US dollars. Yes, back in the day, prior to the dollarization, they would get local currency, but then there is an admission of how the economy has been performing, where you would, if such a farmer who has been doing such a prestigious thing for the economy, they do contribute a lot to our export bill. They should get some recognition in terms of the US dollar that they should get. So with how the local currency seems to be very weak and inflation is biting into the power of that local currency, it brings most farmers to a place where they'll probably hold off most of their tobacco currently, for them to see how things are going to pan out if numbers do, if the policy remains consistent, and if the central bank is going to pay them in US dollars. So currently the central bank is not paying the tobacco farmers in US dollars. They're getting 100% RTGS, and then if they show that they do need the foreign currency, then they have to apply for the 50% that they were promised by the central bank to be paid in foreign currency, which is only put into their Nostro accounts. So that one part has had that effect. Also, there were expectations of the 30-day moratorium that was given exporters that would have pretty much expunged most of their foreign currency within their Nostro accounts, in pushing that foreign currency into the free market. That did not seem to pretty much yield a huge impact on the forex market. If there was a huge influx from that 30-day moratorium policy there, it should have strengthened the rate. But as of late, it still is weakening. Today, it rested at 3.06, which is pretty much 3.1 if we round it off. And then our old mutual implied rate, the South African counter did come off while the local counter on the ZEC went up, so that disparity then increased, bringing that old mutual implied rate to a stronger position of 4.01, a weaker position, sorry. And then our parallel market rate is still pretty much on a stable level. But then just to add a little bit more comments around the 6 extra bureau de changes that have been added, we did talk about how it is going to be a very tight market for these bureaus to be trading in. I mean, they have a lot of limitations that do come in, which one of which is a capital outlay of 15,000, an extreme float of 20,000, and then also only being able to trade 10,000 a day at a rate which is 2.5 plus or minus the interbank rate. So the profits may not be very good for them to push volumes, or for them to play with a weaker rate for them to gain some momentum.
But they still went on to enlist for this whole endeavor, which means they expect some positives maybe sooner or later.
Yeah, maybe
but
sooner or later.
Government has said that they expect a convergence between the parallel market rate and the interbank rate, but we don't seem to have seen that over the past few weeks.
Well, it's a little bit
systems
too.
have actually
It's a little bit too early for us to really look forward to that. Well, Gomatanga did mention that the weakest the rate should get to is about a rate of about 6. So we are still looking at a market that still has a long way to go, and this only has come so far in terms of its promulgation.
Okay. Thank you, Anis, for the insights. Thank you, viewers, for watching. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our website, www.equityaccess.net. From Anis and me, Donkey, and ciao.